Hi, Dominique. Great to be speaking with you about all things markets. We're obviously in a very interesting times right now, and particularly for the US last week, given all the changes that we've seen, and some surprising changes, particularly for the Fed. So would you like to just start off by giving us a quick overview of everything that's happened with Bullard, etc. Maybe give a quick overview of one of the very interesting pieces you've written recently on policy transmission.
Sure. So this was the last week of public speaking before the FOMC meeting, before the blackout period, before the FOMC meeting. And the hawks and doves were out, and the demarcation line between the two is between, in terms of assessment of policy lags, where the hawks think that all of the transmission is behind us, and the doves think the best is yet to come. And the hawks had some very solid arguments. They were saying that, for instance, policy tightening didn't start with the first Fed hike in March of 2022, but instead started when the Fed announced it was going to tighten. So sometime in September, October of 2021. So therefore, the announcement effect had cut 6 months from the lag. Bullard also made a very, very thoughtful argument that the move had been so strong that probably agents had adjusted faster than they would normally adjust to gradual policy changes. Then Logan made some, again, very well taken comments about the fact that, you know, financial conditions have been easing since September of last year. Actually, if you look at the Goldman Sachs Financial Condition Index, it's at the same level as August of last year, when the Fed funds rate was 2.5%. And on the other side, you had the Dove saying, no, tightening is still to come. We could still see an impact from the banking crisis on credit availability. And frankly, didn't have too much to show for their arguments. Bostic, for instance, said that he knew monetary transmission had yet to happen, because this is what his contacts in the business sector were telling him. So there was a strong faith on the part of the doves. Other changes that are important were personal changes. Surprise resignation from St. Louis Fed President Bullard, who was one of the more prominent hawkish voices, probably going to take a long time to replace him. And my hunch would be that his replacement is more likely to be a dove than a hawk. So where does that leave us? I'm still hanging on to my forecast of 2 more hikes this year. One this month, obviously, that's a done deal, and one in November, based on Powell's intent to slow the rate hikes. Since we've had a hike every meeting, I think we've now moved to a hike every other meeting, so that makes it November. And the reason why I think November is still on the table is because of the CPI data. So one of our clients commented that he was surprised at how little attention was paid to base effect. And I have to agree with him. I think the market made a lot of this 3.1% year-on-year headline CPI, when in fact it reflects a 17% year-on-year decline in the inflation, in the energy CPI, and a strong base effect. If you look at the median price CPI, that takes out the more extreme price changes, and that academics agree is a more reliable indicator of trend, especially when you have volatility. it's still above 6.4%. So the slowdown is much more gradual. But nevertheless, I mean, I've read some comments saying that the CPI was a sign that deflation was to come. And someone drew a parallel with what happened after the Spanish flu pandemic in the late 20 after World War I, which to me is a bit far-fetched, especially given that after World War I, the world was still under the gold standard, and now, you know, we are look at central banks' balance sheets. I think the gold standard is a very, very, very irrelevant story. Anyway, the CPI got, I think, more, the headline year-on-year CPI got a lot of attention, in my view, undeserved.
And just on a couple of those things that you mentioned, so in terms of Bullard leaving, how much impact does that really have? Because as far as I'm aware, he's a non-voter, and I suppose this year, if I'm correct.
Correct.
And could it stand sort of empty, the St. Louis seat, for quite a while, or is it likely to be replaced? I mean, is there anything in the interim, or will it be sort of a stand-in, or is it just going to be empty?
President Bullard's influence was largely moral this year. As you said, he's not a voter, but still, I mean, he was an influential and credible voice for the Hawks. And yes, there is a good chance that his seat could stay empty for a long time. Former Kansas City Fed President Esther George retired in January. This was well announced, well ahead of time, and yet we still don't have a Kansas City Fed president. So I believe that with President Bullard, the Hawks have lost an influential voice.
Wow. And in terms of the CPI, you mentioned the reasons to be hawkish on it. Is there anything that I suppose you see in the near term, or when do you think that will start to be fed into the market? When will the market start to realize that it's the underlying strength is persisting as opposed to sort of feeding into the headlines, or do you think that could be quite a while away?
That could be quite a while away, because Mr. Market is in a very ebullient mood. Why not? Strong growth, dovish Fed, and no apparent acceleration of inflation. In fact, you know, everybody loved that low print. That party could have further to go. I think the most important risk that could, you know, puncture this beautiful Goldilocks backdrop could be energy prices. We've seen a rally. Now we've had several of those. This one could be more sustainable because this time around, Chinese consumption is back online. I mean, my view on inflation was that it would be very benign until the middle of the year, where I expected a recovery in energy prices to push up core inflation. And the recovery in energy prices was to be driven by a Chinese recovery. It looks to me like everything has been sort of delayed by a quarter. So perhaps the third quarter is when we will see more pressure on energy prices. And so the continuation of the current rally. And if so, this is very bad news for the Fed and for the bulls out there, of course, because you know, under the two regime model of inflation, so the BIS inflation model, when inflation is high, shocks like energy prices propagate very quickly to the whole of the economy, and so it's very likely, given where unemployment is, the extent of the resource pressure in the US, that if we get a big ramp up in energy prices, we're going to see core inflation move to a higher path. And that that will certainly shatter many dreams. But we are not there. And as always, it's a question of probability. It's not, yeah.
Yeah, and if we were to get that energy spike, would that be consistent with your view for 2 hikes at the end of the year? Or would you expect they might come back a bit stronger into sort of Q4?
It depends on the speed of transmission of energy prices to core inflation, because we have a very dovish Fed, which doesn't mean they will never hike. Obviously, if inflation gets to, I don't know, core inflation gets to 7%, they will have to hike, but they will only hike after there is the data, the inflation data is so strong that it cannot be ignored. So I think a reasonable scenario, if say oil prices go above, say, $90 a barrel in Q4, towards the end of the year, that's when I would expect the Fed to start signaling, a more aggressive posture.
Fair enough. That's very interesting. I was just going to say one thing before we get onto this week's data, and a bit of a segue as well. In terms of the policy transmission, I mean, I know we do have housing data coming in this week, but is that predominantly through the mortgage market and to consumers? Because I understand the US mortgages are pretty long term in terms of duration. Is there any sort of risk that is that the sort of line that the doves are taking, I suppose, that there's not that much has fed through into the market yet, or how are you sort of seeing that, I suppose?
So I wrote about this in September of last year, and basically made a point that everybody is now making, which is, yes, US household, 80% of their debt is mortgages. Mortgages are funded on 30-year at fixed rates. We are coming out of a period of super low interest rate. So policy tightening was always going to impact only the marginal borrower, not the average borrower. In fact, the BEA in the US that publishes the national accounts has an estimate of the average mortgage paid by household, and it's still around 3%, 3.5%. So sure, and then we had the issue of the very strong balance sheet with the household net worth still above where it was relative to disposable income, where it was before the pandemic. And now with the recovery in equity prices, as President Logan said, financial conditions are easing. And then you have other issues like fiscal policy, which is probably the loosest since the 70s, perhaps even looser, if you look at the deficit, which is encouraging a buildup of cheap plants, which were actually such a big buildup that we are seeing it in the data. So non-residential construction is going gangbusters. So yeah, I mean, transmission. So monetary policy needs to be extra restrictive because fiscal policy is so loose.
Yeah.
And yet, because we are coming out of a period of super low interest rates, and because of the strengthening of household balance sheets that followed the GFC, policy is not having an impact, which is the view of the hawks, basically. So we shall see, but I fear this beautiful drop in the headline year-on-year CPI might just end up a mirage.
Yeah. Well, we've got a little bit more data to find out on that front next week for sure. So, I mean, I'm happy for you to sort of lead on that, but I mean, I think the most important things or most interesting things are certainly going to be retail sales for June and housing data. So how do you sort of see them sort of shaping up next week?
So retail sales, actually, the consensus is quite strong if you take into account the core goods price deflation we had in June. So we could have real goods consumption around 0.5 percentage point month on month, which is really large. And especially so when you set it against the backdrop of a recovery in services consumption, which is still happening now. I mean, services are still growing faster than before the pandemic. So we have a household sector that is really going gangbusters. And as you know, the US economy is 70% consumption. So if you can figure out what is going on with household, you basically got growth figured out. And that's also what the Atlanta Fed GDP nowcast is showing. GDP growth at 2.3%, so above trend. This is not at all what the Fed was expecting. And in all fairness to Fed speakers, whether they are doves or hawks, they are all acknowledging that growth has been more resilient than they expected. It's just that the doves think that, 2 more rate hikes and we're done. The Fed can cut 100 basis points next year. That's what they are planning. And the inflation will go to 2.5%. Core PC inflation will go from currently about 4.5% to 2.5% next year. I have my doubts, but again, it's a question of probability. I don't assign it to 0 probability. It's just a very small probability. So let's see. But so back to the data. So we have retail sales, and the other thing that's important is residential real estate data, because it will confirm that this sector that is the most interest rate sensitive of all the categories of demand, this sector is actually recovering, which is, a comment that was also made by Dallas Fed President Logan. And then we will have data on manufacturing, which, as always, will be doom and gloom, though, if the dollar continues to weaken, that could help the manufacturing sector. But in any event, this is about 10% of the economy, both in terms of value added and in terms of employment. So nothing to get really worked up about.
Oh, okay. Yeah, no, I mean, it's an interesting retail sales story, particularly because, I mean, contrast to sort of Europe, UK, where it's just been sort of in real terms consistently declining. There has been much more sort of definite strength in the US. That's kind of certainly feeds into your view. Yeah.
Why do you think that is the decline in Europe?
I mean, I think the sort of baseline is that obviously adjusting for prices. So, I mean, nominal spending has gone up a lot, but real spending has just been kind of squished by inflation, really. Households, real incomes have been, or real wages have been negative across pretty much everywhere. Even the UK, where we got pretty strong wage growth, the headline inflation has just been sort of outstripping it. So there has been quite sort of a lot of pressure, particularly UK, on consumer, on households. Which sometimes I feel, at least from our analysis, doesn't get picked up in the aggregate numbers so much. You kind of have to delve into the sort of, as you mentioned, around the sort of house buying, the sort of marginal ones, so to speak. But I think UK in general, the mechanism for prices, be it rents, be it sort of when prices adjust year on year, generally in April, has all been quite sort of detrimental to the consumer at the end of the day. It's been put quite a lot of pressure on them. So next week's inflation will be interesting, but
that is really interesting, actually, this point you are making about wage and price behavior, because I think one big difference between the US and Europe is that in the US, the labor market is more flexible. So wages in period of inflation perhaps adjust faster. And in fact, one thing I should have mentioned is we're going to have a strike, not the Hollywood strike that you heard about, Meryl Streep going on strike. Okay, that made the frontline news, but from a market perspective, not that important, let's face it. I was thinking more about the UPS strike. Okay. So it's a company that delivers parcels in the US. And I believe it will be the largest strike in terms of employees, 460,000 in US history.
Really?
In the first strike for UPS since the 70s. So Americans' real wages have been contracting, just like Europeans. The growth in the real wage growth has been accelerating, but obviously people are not happy. So we get strikes, and it's absolutely extraordinary that I hear people in the, the doves in the Fed, but also economic commentators call for deflation, for stable inflation, when all they need to do is really lift their nose from their spreadsheets and look at what is going on in the real world. And what we are seeing is labor unrest, and usually labor unrest means faster wage, not slower wage growth. So again, I could be wrong. It's always a question of probability, but it looks to me that perhaps one of the reasons growth is stronger, consumption growth is stronger in the US and in Europe, is that wages adjust faster in the US and in Europe.
I mean, that's a very good point. And I mean, UK has been sort of dominated I mean, we get all sorts of strikes. It basically drives our month-on-month GDP. But public sector pay is a big sort of under discussion right now. And the government's current line is basically they'll pay for it, but they'll pay for it out of the budgets, the current budgets, basically. So departments will have to find sort of cuts somewhere. But I mean, on the whole, I mean, public sector pay has sort of lagged private in the UK, but it has been it's been moving far faster than in Europe, for instance, and risen far faster than in Europe, and it's tended to be much more sort of mobile in that regard. I think Europe has a big issue whereby they have probably a more significant lag on wage negotiations, and the ECB does track it, and they track it quite a lot. And I think that is going to be something that, especially when you've got a continuing tightening labor market in Europe, that's going to weigh on, or sort of to help support inflation into the medium term, I feel. And I think that is what the ECB is particularly worried about. If you look at why they sort of, the rationale behind their sort of capitulation at the last sort of forecast meeting, it was all basically unit labor cost into the medium term. So it'll be very interesting, and we will be putting out pieces on drivers of inflation between the UK and Europe, probably Germany, in the coming weeks. So do keep an eye out for that.
Looking forward to that.
Absolutely. Which leads us quite nicely to other pieces of interest in the week. So obviously we do have yourselves. So Dom's piece on policy transmission, which is really worth a read, as with all your pieces. We've also had Billal's written macroscope on why FX carry's been outperforming this year and why it may not last ahead. And we also have a piece by Richard Jones on why sterling and UK short end yields have room to fall in tandem ahead post labour market data, which I've also sort of written on. And the inflation release this week for the UK will be quite important on that front. I think myself and Richard both sort of in agreement on the risk being basically not necessarily the risk of the data outturn, but the risk for market reaction is probably, it will be a stronger reaction if there was to be a miss. And if there was a beat, that would probably just sustain some of the hawkishness that's being priced in right now. So there's a lot going on, a lot of interesting stuff to read on our website. So please, for all our listeners, watchers, do take a notice. But thank you very much once again, Dominique. It's been a really, really interesting talk, and I hope to speak with you soon in the future.
Thank you, Henry. Have a great weekend.
Cheers. Take care.